Let's jump back in time to 1980. We're talking high inflation, a ton of market uncertainty. Sounds a little familiar, right? Well, in that year, Warren Buffett wrote a letter to his shareholders that was so much more than just an update. It was, and still is, a masterclass in how to see what everyone else is missing. We're going to dig in and unpack the hidden secrets from that letter, and trust me, they are more relevant today than ever.
So Buffett kicks things off not with a bunch of numbers, but with a question. It's a challenge, really, that should make every single one of us stop and think. He basically asks, what if that one number everyone obsesses over, a company's reported earnings, is actually hiding the most important part of the story?
And for Berkshire Hathaway, hey, this wasn't just some philosophical question. This was their actual reality in 1980. Get this, the earnings that didn't show up on their official books were bigger, actually larger, than their entire reported profit for the year. Just let that sink in for a second. The invisible part was bigger than the visible part. How in the world is that even possible?
Well, it's possible because of what Buffett so brilliantly called the earnings iceberg. It's just the perfect metaphor, isn't it? What you see on an income statement, that's just the tip. It's that little visible piece of ice bobbing above the water. But the real mass, the true economic power of the company, is all hidden down below the surface.
So why does this happen? It all comes down to some surprisingly simple accounting rules. If you own more than 50% of a company, all its finances basically get rolled into yours. Easy enough. Between 20 and 50%, you get to report your slice of their profit. But here is the rule that changes the entire game. If you own less than 20%, the only thing you can count as earnings are the actual cash dividends they pay you. All those profits the company keeps to reinvest and grow, poof, they just vanish from your income statement.
Now for Berkshire, this wasn't just some tiny accounting quirk. No, it was at the very heart of their business model. Their insurance operations generated this massive flood of cash, the famous float, and they had to invest it somewhere. Their whole strategy was to buy small pieces of a whole bunch of really excellent companies, which meant nearly all of their investments fell into that invisible sub-20% bucket.
And that whole situation led Buffett to write one of his most legendary lines. He said, "Conventional accounting only allows less than half of our earnings iceberg to appear above the surface, in plain view. The real, true value was completely hidden from anyone just looking at the official numbers."
Buffett's whole point here is that accounting rules don't create value. Business operations create value, right? What really matters is what the managers of those companies are doing with the money they're holding on to. If they're reinvesting it wisely and growing the business, that's real value, whether an accounting rule says you can report it or not.
Okay, so seeing the whole iceberg is step one. But in the same letter, Buffett warns us about another invisible enemy. This is a force that can quietly eat away at your wealth even when it looks like you're winning. Inflation. He calls it a phantom tax that most investors just completely forget to account for.
And to make this idea painfully clear, he doesn't use complicated charts or economic formulas. Nope, he uses hamburgers. This brilliantly simple test is all about showing the difference between making more dollars and actually being able to buy more stuff.
All right, walk through this with me. Imagine you have enough cash right now to go out and buy 10 hamburgers, but instead you invest it. A few years go by, you get some dividends, and after you pay taxes, you can buy 2 hamburgers. Then you sell the investment, pay taxes on your profit, and with what's left, you can buy another 8 hamburgers. So you have 2 plus 8, that's 10 hamburgers worth of buying power. You started with 10, you ended with 10. Sure, the number of dollars in your account went up, but your hamburger power is exactly the same. Your real gain was 0, nothing.
And this leads to maybe my favorite line in the whole letter. Just brilliant, simple, and perfect. You may feel richer, but you won't eat richer. It just perfectly captures the illusion of inflation. It makes you feel like you're moving forward when you're really just running in place.
He gives us another great visual for this too. He says, high inflation is like trying to run up a down escalator. The higher the inflation rate, the faster that escalator is moving against you. You have to generate these massive returns just to stay in the same spot, let alone make any real progress climbing to the top.
Okay, so this isn't all just theory. Buffett then shows us exactly how these two monster ideas, the hidden earnings iceberg and the inflation escalator, came together in one of his absolute best investments ever, Geico.
And right here, you can see the Geico iceberg in black and white. So Berkshire invested $47 million. Because of the accounting rules, they were only allowed to report about $3 million a year in earnings from that investment.
But Buffett, he looked under the hood, he calculated that Berkshire's true share of Geico's underlying earning power was actually closer to $20 million. The hidden value was almost 7 times bigger than what was on the books.
And because of that difference, they got an absolutely mind-blowing bargain. Berkshire was able to buy $20 million of annual earning power for a one-time price of just $47 million. Now, to get that same kind of earning power by buying an entire company out in the open, Buffett figured that would have cost them over $200 million. By seeing the iceberg, they got a steal of a deal.
Now, it's super important to understand why this opportunity was even there. A lot of people on Wall Street saw Geico as this broken, failing company because it had gotten into some serious trouble. They saw it as a risky turnaround play. But Buffett saw something totally different. He didn't see a broken company. He saw a fantastic business that just had one temporary, totally fixable problem. The engine was still amazing. It had just sputtered for a moment.
And that Geico story perfectly illustrates one of his most timeless principles. He warns that when a brilliant manager takes on a business with terrible economics, it's usually the business that wins, and the manager's brilliant reputation gets tarnished. Geico was the exact opposite. A brilliant business that just needed some common sense to get back on its feet. The quality of the business itself, that was the key.
So after he shows us the hidden iceberg, warns us about that inflation escalator, and then walks us through a real-life example with Geico, Buffett ties it all together for us in a super clear, powerful framework for how to invest.
And this is really the heart of the whole letter. First, you have to look past the official numbers to see what's really going on with the business. Second, you can never ever forget that inflation is a real tax that will destroy your capital. Third, you've got to focus on businesses that have some kind of durable, long-lasting advantage. Fourth, find managers who are great at taking the company's money and putting it to good use. And finally, and this ties it all together, you judge those managers not on what they say, but on the results they get with the money they keep and reinvest.
Ultimately, the entire philosophy, the whole shebang, comes down to this one simple test. The goal is to find those few special businesses where the management can take $1 of the money they keep and, over time, turn it into more than $1 of real value for you, the owner. That's it. That is the essence of great investing.
And that leaves us with one final question to ask ourselves. The next time you're looking at a company, just ask, am I just looking at the tip of the iceberg, the part that everyone else can see? Or am I really doing the work to understand the powerful economic engine that might be hidden just beneath the surface?